Halfway through the year, and against almost every headline you have read state, global equity markets are up. Think about what we have lived through. A war involving Iran, oil prices grinding higher, inflation expectations climbing. On paper, the recipe for a difficult market. And yet, equities have delivered. It's a useful reminder that over time, markets don't trade on headlines, they trade on earnings. I'm Charles-Raymond Chaud, and this is our mid-year outlook. So, what is the story of the first part of the year? Earnings have been the story. The strength of global earnings growth has more than offset the geopolitical headwinds, and the single biggest driver has been the AI CapEx supercycle. This is no longer just a US phenomenon. Yes, the American mega caps continue to lead, but the AI-driven investment boom is now lifting earnings revisions across emerging markets too. The economies that build, supply, and power these build-outs are increasingly on the right side of it. And it wasn't only AI. Beyond the technology names, reflationary assets did well. Small and mid caps and commodities both outperformed. The underperformers tell the other half of the story. Government bonds, gold, and Bitcoin were left behind. So the lesson of the first half is a simple one. In a world of elevated uncertainty and elevated volatility, staying invested was the rewarding strategy. Sitting on the sidelines waiting for the headlines to clear would have cost you. So, as we head into the second half, what lies ahead? Our core view is that the major secular trends remain firmly in place. Geopolitical tensions, fiscal dominance, the AI CapEx supercycle, and an environment of elevated nominal growth. Taken together, these forces continue to favor equities and real assets over fixed income. That remains our compass. But we are watching the road carefully, as there are risks that could lead us to lean more defensive. First, the earnings story cannot run forever. The bar has been set very high. Expectations are demanding, and when expectations are demanding, disappointments are punished. Second, oil. While markets are closely monitoring developments in the Middle East, there is a risk that geopolitical tensions and supply disruptions persist longer than expected. In that case, we could see another upward move in oil prices. And that's the scenario that worries us the most, because it's the one that could push markets to start pricing in stagflation. Third, there is a new Federal Reserve chair. In a context of rising inflation expectations and elevated public deficits, markets may well be tempted to test him. How that credibility is established or challenged matters for every asset class. And finally, we have to stay nimble and selective. The AI revolution is creating winners and losers. This is not a market to own passively and look away. It's a moment to adapt and to position portfolios on the right side of the trade. So, our message into the second half is this: stay invested, but stay disciplined. Lean into the secular trends, but respect the risk, and above all, be selective. At the start of 2026, every headline said, "Be cautious." The market said otherwise. Our view is the same as it was in January. Trust the fundamentals, not the noise. On behalf of the entire investment team at Swiss Bank, we wish you a relaxing summer and a successful second half of the year.